This is a story about the stocks that changed the world. They grew faster and made more money than any other sector in history. They changed the way we work, consume, and communicate. Their market cap is larger than the GDP of almost every country on the planet. This is the technology sector. Its latest boom was so long and so transformative that some took its historic growth for granted. But then along came 2022.
Layoffs in the tech industry.
Meta to Amazon, Twitter, Salesforce, thousands of job cuts.
As the bad news kept coming, record highs were replaced by record falls. Some see red warning signs to come in 2023.
There's a very good chance we're going to be going into a recession in the next 12 months.
Others have kept the faith.
The future is going to continue to be tech.
But is this just a market recorrection, or the warning sound of a bubble about to burst? Here at Capital.com, we make explainer videos about investing and economics, giving you the insights you need to understand what's going on in the markets and to make informed trading decisions. We're also a trading platform ourselves, so you can make your trades right on our platform or using our app. After this, you might want to check out our recent explainer on investing in a recession. We're used to the queuing, the dancing, and the baffling.
Yeah, just gotta find something to wear.
But above all, we're used to watching tech profits go from strength to strength.
I don't think we've ever seen another period in U.S. history that we saw such concentration of profit in the handful of companies. And that is a result, not because, again, their technological prowess, but by the virtue of the fact that they operate in industries that gave them this monopoly status that was clearly not sustainable.
By the end of 2021, the Nasdaq had more than doubled in value. While Apple started 2022 by becoming the first company to break the $3 trillion barrier. But as 2022 progressed, the noise of champagne corks was replaced by the sound of screeching brakes. Meta racked up losses of $600 billion, while Microsoft lost $700 billion. The Nasdaq fell 30%, wiping $7.4 trillion off investors' portfolios. That's more than the GDP of every country on Earth, apart from America and China. Feeling smug that you're not holding tech stocks? Think again. FAANG companies are so big, they make up almost a fifth of the S&P 500. If you're invested in a stock market index, you're invested in tech. Got a pension? That's probably invested in tech too. Like it or not, tech losses are probably your problem. But just how worried should the tech sector and the rest of the market be? We're going to take you back to a simpler, more innocent time, the 90s.
Hello.
The kids were listening to grunge. Ross and Rachel hadn't got together, and Justin Bieber hadn't started singing. Not in public anyway. On top of that, the school nerds were using something called the internet. Turned out to be more than a passing trend. Cheap computers accelerated the boom, and even the most technophobic pensioners found themselves online. The world of business lost its mind. Billions were poured into businesses that didn't have a business plan. Companies like Pets.com raised over $80 million in record time and went bust just 9 months later.
In 2001, 40 to 50% of the companies in the Nasdaq failed because they weren't real companies. They were vaporware.
Companies had no earning, no prospect, no nothing. They were able to raise a lot of money just by calling themselves a .com company.
The late 90s tech boom was fueled by low interest rates, promises of outsized returns, and commitments to products that never arrived. Now, how does 2022 compare?
Technology companies, they need to basically be judged by whether they are actually adding to productivity, okay, making us more productive in the process. And there's no question, I think for the most part, this was the case.
But before we pat ourselves on the back for not making the same mistakes, let's have a look at the data. In the run-up to 2001, The Nasdaq rose 402%, but then lost 77% of its value. While in the 5 years before 2022, a smaller rise of 242% was followed by a less eye-watering fall of 36%. If you've watched our films before, you'll know we use the price-to-earnings ratio. You take the share price, divide it by the earnings per share, and you're left with a number. But which was more overvalued, 2001 or 2022? In 2022, the S&P 500 Technology Index PE was less than 30, meaning companies were trading at 30 times the share price. But back in 2001, that number was nearly 50, meaning the technology sector was far more overpriced. If you're worried that 2022 is still in the eye of the storm, you may have a point. The strength and depth of today's tech slump might be down to the people that work here. They say rate rises are the great leveller. They impact both mom and pop stores and trillion-dollar companies. But for once, the big boys might have it worse than the little guys. And that's because of the way Wall Street values its stocks.
It's very important to understand the drivers of the underperformance of the tech sector. I think obviously, one reason is higher interest rates. Companies that are earning very little today that rely on future earnings need long-term interest rates to discount their future cash flows into come up with a present value.
Today's tech stock value is based on tomorrow's expected growth. But their uniquely high growth projections make them uniquely sensitive to interest rates. And because the higher interest rates go, the less money the markets expect them to make in future. And that hits their stock price.
People invest in a company, especially the tech sector, based on what they're going to do in 5 years, based on what they'll do in 10 years. This is why companies trade at these ridiculous multiples of their earnings. Because no one is looking at their current earnings.
So if you want to gauge the health of the tech sector, you should keep an eye on 10-year bonds and yields. 10-year bonds are an IOU note from the US government. The yield is the amount the investor earns. Rising yields reflect positive expectations about growth, but that can lead to higher inflation and rate rises, which translates into bad news for the tech sector. The price of 10-year yields rose across 2022, reflecting high inflation and rising interest rates. It had an almost perfectly inverted relationship with the value of the Nasdaq. The higher the threat of interest rates, the further the Nasdaq fell.
It's more mental, it's more psychological. That people associate a falling interest rate with a rising stock market and a rising interest rate with a falling stock market. I think while the correlation is there, that correlation is way more psychological.
The big question for tech is whether 2022 was a passing tremor or a taste of the shock still to come. It took the Nasdaq 15 years of reinvention and restructuring to recover from the dot-com crash. So what are the reasons to fear the worst? An existential threat may come from the shifting sands of global politics.
The West has cut off Russia, which is a pretty big market. If Russia now builds their own tech sector to compete with the US, so every single Russian speaker in the world, which is quite a large number, they won't use American companies because A, they're banned or they don't want to. This is splitting the world, and that is certainly going to hurt the stock market.
Another tech threat comes from the world's failure to define what this really means. The First Amendment, which protects freedom of speech. Some worry that if online speech isn't as free as it should be, it could turn people off tech.
Every social media platform, even Twitter. If Elon Musk didn't buy Twitter, I expected that stock to go down to $10 and under. People are really, really angry that they are being censored on the internet. Their speech is being controlled. They have to watch what they say for political reasons.
But the success of companies, countries, and continents might be defined by who has control of one thing. They're needed for communications, computers, healthcare, fridges, and phones. Basically every electronic device on Earth. And they look like this.
The semiconductor group has already been hit, okay, over the past basically 6 months, okay? And I think to a great extent, this having to do with the tech war that the US has declared on China. China accounts for 40% of the world's consumption of semiconductors. 40%. So you're talking about 40% of your revenue getting hit pretty hard.
There's nothing to say that FAANG companies of today won't be the Polaroid or the Blockbuster of tomorrow. But it's not hard to find plenty of room for plenty of growth. For starters, only 63% of the world has access to the internet. 27,000 people go online for the first time every hour of every day. While relatively new technology, like battery-powered cars, are in their infancy in terms of market reach. Just 10% of the world's cars currently run on electric batteries. That was one reason why Morgan Stanley predicted Tesla's share price could rise 94% over the next year. Tech may also receive some stability from global instability, because the worse things get outside, the more people may want to escape online.
The VR space, for example, that's going to blow up. The metaverse, as they call it, because people want to get away and you want to disconnect. You want to put that VR set on and forget that there's riots outside your door.
And the true future of tech may not lie in front of us, but above us.
There's no doubt that the migration to the cloud is continuing, simply because companies like Microsoft and even Amazon, or Google for that matter, have made it really very cost effective for companies to actually outsource their data storage to these companies as opposed to keeping everything in-house. I suspect that migration is set to continue, and I think from that point of view, that is going to be a very important, source of growth for these companies.
Some tech companies will be big enough to ride the economic waves, and others will need to adapt to survive. But the companies that thrive will be the ones who win the race to control tomorrow. Thanks for watching. Remember that the price of stocks and shares may vary depending on changing market conditions. You can read more of our analysis by clicking on the links in the description below. And don't forget to subscribe to stay alerted to our regular chart analysis videos each week and other explainers on big financial topics of the day.